things are getting exciting in your part of the world again. I mean, it makes sense, right? You talk about the growth differentials, the monetary policy differentials. You can see why you would see that being expressed in the yen and the yuan. How far can that dollar strength go?
Well, we're still well below the highs, but we were up almost 5% from the lows that we saw in July. So we're bumping up against some levels that, could be reasonably significant at least. And I think what we really need to see as well, it's not just the evident strength of the US, but it's the evident weakness coming through in the Eurozone. Maybe would like to think we're probably at peak pessimism there. And obviously we need to see signs of an improvement in growth in China that's so far lacking. So, while that relative growth outperformance is there, while US yields, particularly in real terms, looking at real yield differentials, so adjusting for inflation expectations, there's still, it's very hard to find a reason to be disinvesting from US dollar assets for the time being. So we're really going to need to see, clear evidence that the Fed is done tightening, and obviously last night's ISM numbers have given that thought a little bit of a kick in the stomach, if you like, and that rates are going to be heading down next year. I think we do think that narrative will emerge, and probably before the end of the year, but unless or until it's on display, I think the dollar will remain dominant.
How effective will intervention measures be, whether you're talking about Japan or the PBOC's guidance on the yuan?
I think the PBOC's guidance is, I don't believe for 1 minute that they're actually intent on reversing the upward trend that we've seen in the dollar-yuan exchange rate. And one of the reasons I say that is while the Japanese yen remains as weak as it is, I think Beijing will remain resistant to seeing their currency strengthening against the Japanese yen, because that implies a loss of export competitiveness vis-a-vis Japan. So, for all the sort of jawboning or for all the setting of the fixes so far beneath, where Bloomberg's consensus is saying that a market implied rate would be every day, I think it might be checking the rise in dollar-yuan, but it's not going to reverse it. And then the other big issue, of course, will be whether we do see Bank of Japan intervention. We've seen, MOF's currency czar, Mr. Kanda, out making similar comments to those which we saw prior to the intervention, which we saw last September and October. But, while the moves are pretty controlled here, I think we're probably going to have to be much closer to 150 on dollar yen before we might expect intervention.
But Ray, that might not be too far away if the dollar keeps strengthening, and we really have the double whammy of those higher interest rates and the strengthening dollar and strong economic data. The Fed staff apparently pricing out a recession and perhaps even doubling their growth forecast. That surely will strengthen the dollar even further.
Well, you'd have thought so. I mean, the big driver of dollar yen, as far as the levels at which intervention alarm bells are likely to be ringing, is probably closer to 150. And it's worth reminding ourselves that, 10-year Treasury yields, which have been the main arbiter of the volatility in all things yen, while the BOJ sits studiously on its hands. So we probably need to see 10-year Treasuries heading back up to the recent highs above 430, maybe heading up towards 450. I think that environment, you will see dollar yen at the levels where intervention becomes realistic. But we have to remember dollar yen is here for a reason. It's here because of interest rate differentials. Intervention will work temporarily, but it's not going to arrest the underlying weakness of the Japanese yen while the BOJ stands pat.
Exactly. And so do you look at things like open interest in yen futures or US yen futures in order to tell you whether the Bank of Japan or the ministry or somebody will do something about this, or will they ignore it?
Well, they are important, but I've always looked at positioning data, particularly from the International Monetary Market or the IMM. I think they only provide perhaps some useful signals when they really are at extremes, and there's nothing, I think, in the current sort of IMM futures complex to suggest we're at sort of the extremities where something like intervention would be leaning into extreme short positioning, and that would therefore have more chance of meaningful success.